Today, financiers rapidly turn to this area to see if the company is in fact making money or not and what its funding requirements are. Guide to Financial Statement Analysis. This guide is designed to be beneficial for both beginners and advanced financing professionals, with the main subjects covering 1. Earnings declaration, 2. Balance sheet, 3. Capital, and 4. Rates of return. Image, example financial analysis template. 1. Income statement analysis. A lot of experts start their analysis of financial statements with the earnings declaration. Intuitively, this is generally the first thing we consider with a business. We often ask concerns such as, just how much revenue does it have? Is it rewarding? What are the margins like? In order to answer these concerns, and much more, we will dive into the income declaration to start. There are two main types of analysis we will perform: vertical analysis and horizontal analysis. Vertical analysis. For instance, in the earnings declaration shown listed below, we have the overall dollar amounts and the portions that make up the vertical analysis. As you see in the above example, we do an extensive analysis of the earnings declaration by seeing each line item as a percentage of income. The crucial metrics we look at are cost of goods sold, COGS, as a percent of earnings, gross profit as a percent of earnings, devaluation as a percent of income, selling general and administrative, SCANDA, as a percent of income, interest as a percent of earnings, profits before tax, EBT, as a percent of revenue, tax as a percent of income, net earnings as a percent of revenue. Horizontal analysis. With horizontal analysis, we look across the income statement at the year-over-year, YI, modification in each line item. In order to perform this workout, you require to take the value in period N and divide it by the value in period N1 and then deduct 1 from that number to get the percent modification. Profits in 2017 were $4,000, and in 2016, it was $3,000. The I modification in profits amounts to $4,000/$3,000 minus 1, which equates to 33%. 2. Balance sheet and leverage ratios. Let's move on to the balance sheet. In this section of financial declaration analysis, we will evaluate the functional effectiveness of the business. We will take numerous items on the income declaration and compare them to the company's capital possessions on the balance sheet. The main liquidity ratios for service are quick ratio, existing ratio, net working capital. The primary take advantage of ratios are debt to equity, debt to capital, debt to EBITDA, interest coverage, fixed charge coverage ratio. The main operating performance ratios are inventory turnover, accounts receivable days, accounts payable days, total asset turnover, net asset turnover. Using the above monetary ratios, we can figure out how effectively a company is creating income and how rapidly it's selling stock. Using the financial ratios derived from the balance sheet and comparing them traditionally versus market averages or competitors will help you assess the solvency and leverage of a business. If you liked the video, you're welcome to subscribe and give a like. In our course on the analysis of financial statements, we check out all the above metrics and ratios in great detail. 3. Cash flow statement analysis. With the income declaration and balance sheet under our belt, let's take a look at the cash flow statement and all the insights it informs us about the business. The cash flow declaration will help us comprehend the inflows and outflows of money over the time duration we're taking a look at. Capital Statement Summary. The capital declaration or declaration of capital consists of three parts. Cash from operations. Cash used in investing. Cash from financing. Money from operations. Money utilized in investing. Cash from financing. Each of these three areas tells us an essential and distinct part of the company's sources and uses of money during the time period being examined. Many financiers consider the cash flow statement the most essential sign of a company's efficiency, and it's hard to think of. Up until only just recently, businesses didn't even have to submit a capital declaration. Today, financiers rapidly turn to this area to see if the company is in fact making money or not and what its funding requirements are. It's crucial to comprehend how various ratios can be used to effectively evaluate the operation of a company from a cash management perspective. It's crucial to comprehend how various ratios can be used to effectively evaluate the operation of a company from a cash management perspective. Connecting the three declarations together in Excel is the foundation of financial modeling. 4. Rates of return and success analysis. In this part of our analysis of monetary statements, we unlock the motorists of monetary performance. By using the pyramid of ratios, we are able to demonstrate how you can determine the leverage, profitability, and performance drivers for any organization. This is the most sophisticated area, and we advise that you see a presentation of how experts perform this analysis. The course consists of a hands-on case study and Excel templates that can be utilized to determine specific ratios and a pyramid of ratios from any set of financial declarations. The key insights to be stemmed from the pyramid of ratios include return on equity ratio, ROE, profitability, efficiency, and leverage ratios, primary, secondary, and tertiary ratios. DuPont analysis. By building the pyramid of ratios, you will get an exceptionally solid understanding of the business and its monetary statements. More analysis of financial statements. We hope this guide on the analysis of financial statements has been an important resource for you. Thank you for watching this video on Brainy value. See you in the next video.